Welcome to my channel. I'm the cover call guy. My goal is to hit $120,000 per year in passive income using only cover call ETFs. My portfolio currently yields $70,000 a year and about $6,000 a month. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss in principal. Please always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you found online and I could be completely wrong. Now, with that out the way, today's video is going to be from a comment left on my video from Jerry B751 for requesting this video. Jerry wanted to find out if there are cover calls that has high yield, NAV growth, downside protection, and some tax efficiency. So I said, you know what? Let me do my deep dive research, and let me see if I can find as much cover call ETFs that has all four. And there's about 440 cover call ETFs on the market. I went through all of them. And then I pretty much filtered down to about 30, and then from 30 I just kept filtering down to as little as possible, and this is the list that I've come up with. So Jerry B751, I hope you enjoyed the video. I hope you like it. Fact check me, leave a comment on what you think. Maybe you agree, disagree. Anyways, Jerry B751, thank you for leaving a comment and requesting this. Here's your video. Let's get started. Are these the best all-rounder cover call ETFs that I found and that I put a list of together? All right, the unicorn paradox. You can't win it all, right? So let's just get it straight from what I've found right off the bat. No single ETF on the market meets all four criteria simultaneously: the high yield, NAV erosion, tax efficiency, and downside protection. You can't win it all. So we're gonna have to give up a little bit of something, right? We might have all three, or we might have 3.5. And this is the list I came up with. Alright, bro, in this presentation, we'll try to be finding the best cover call ETF with at least all three: the high yield, the NAV growth, and the downside protection. The three generations, tax autonomy, which is generation 1, is your traditional cover call ETFs such as QYLD, ROLD, JEPI, and JEPQ. Well, JEPI and JEPQ, I would say they're more like Gen 2, but I'll just put in Gen 1 for this purposes, right? They prioritize you above all else and fails at NAV, which JEPI and JEPI don't, but because they have such bad tax efficiency, I just put it with that list. They could be in Gen 2. And then we have Gen 2, which is the enhanced cover call ETFs. Solves the NAV erosion, right, with dynamic calls and uses tax-deferred return of capital, but not tax advantage. There's a difference, right? Example of these are GPIX, GPIQ, DIVO, IAUI, which I own some of these ETFs. I love them. And then we have Gen 3, which is a tax advantage, the gold standard, in my opinion, right? Solves the NAVs using spread calls, has tax efficiency using Section 1256. All together, right? Some of these are SPYI, ISPY, XYLG, IWMI. And then this is the master scorecard, right? The Gen 3 income funds, right? We have SPYI, QQQI, IWMI, NIHI, ISPY, IQQQ, ITWO. And as you notice, NEOS is dominating. They were absolutely a beast in this is my terminology, it's not an actual term, the Gen 3 cover call ETFs. I absolutely love NEOS. Not sponsored, they don't pay me, I just love what they're doing. That they have an absolutely amazing strategy, and they're executing it very well. And then we have some of from ProShares. And then coming in part 2, XYLG, QYLG, RYLG, and DYLG from Global X. Their yields they're still high, but they aren't in the double digits. That's why I put them in part 2. They have good tax efficiency. They have decent yields. And then I put a note here. right? These Gen 3 solves NAV erosion by only writing calls on 50% of the portfolio, retaining 50% of the upside. And then we have Gen 2, right? We can't forget about the Gen 2. Gen 2 can also be a core. It just depends on how you use them, right? So Gen 2 is the return on capital tax deferred funds, such as GPIX, GPIQ, DIVO, QDIVO, IAUI, and again, Goldman Sachs Amplified and NEOS, one of the three best amazing ETF funds, right? Cover call ETF funds right now on the market. They are also absolutely dominating. And then the master scorecard for protection focused hedge funds, SPYI, QQH, XRMI, QRMI, XCLR, and HELO. Again, NEOS is making the list. They are absolutely just dominating in every like sector that you want. You want the upside, they have it. You want the downside, they have it. You want to be stable and don't really move anywhere and more like a high use saving account, they have it. They have everything, right? It seems like it. And then with the new Boost ETF coming out, it seems like they're trying to get into the leverage game too. So we'll see about that. So, and then of course the hedge funds. No, I'm sorry, not hedge funds. Hedged funds that they've put out, right? In the red, they are capped, but that's because that's how they that's their strategy. It's capped. It's not going to be partial or no cap, because hedge is just so that what it means, hedge, you have some downside protection, right? That's the whole point. And then choosing your strategy, right? So high yield, right? You have the QQI, IWMI, ITWO, right? You accept the highest volatility, the Nasdaq Russell, and no downside protection. And then you have the balance plus Gen 3 tax, SPYI, ISPY. You accept the full SP 500 volatility in exchange for high tax advantage income. Then you have kind of like the balanced yield and the Gen 2 tax, right? So not the highest yield and not the craziest tax protection, right? GPIX, GPIQ, which are two of my core also. Functionally similar to tax outcome deferred, but uses ETF options, not index options. And then you have the NAV growth plus the Gen 3 tax, XYLG, QYLG, RYLG, right? You sacrifice half of the yield of other funds to retain 50% of the market's upside. And then you have the yield plus deep protection, which are the hedge, right? You get high yield and a defined buffer, but you sacrifice all equity upside. And then you have the protection plus Gen 3 tax, right? These are the hedges, SPYH, QQQH, XRMI. You sacrifice all or most of your upside potential to pay for the protection. And then here is just a comparison of the top income funds, right? Again, you see NEOS just makes the chart, right? The blue bars equal Gen 3, which uses tax section 1256, and the orange bars is Gen 2, which is mostly return of capital, tax deferred. So you see here, they do amazing, right? So some great ETFs that I found, it definitely have been put on my watch list, and now in my circle of what I might want to buy if I want to add more diversification to my portfolio. All right, then we get into the Gen 3 strategy deep dive, right? How they solve the NAV erosion. We have to understand how they do this, right? So NEOS uses call spread. They sell call option to generate income, but also buy it further out the money call. This spreads retain the potential for upside capture. SPYI, QQI, IWMI, and ProShares do this with 0 date time expire options. They sell new call options every single day that expires at the end of the day. This daily resets pretend getting locked in at a low strike, right? ISPY, IQQ, ITWO, and then Global X 50% overwrite, and just like I mentioned in previous slides, 50% of the portfolio has calls on it, and 50 is uncovered, so they can do whatever they need to do in a market upside or bull run or market downside. Gen 2 strategy deep dive, how they solve NAV erosion, right? Goldman Sachs, they uses dynamic flex, which is just basically a customizable flex option on ETFs, and dramatically adjust coverage, writing calls only on 25 to 75% of the portfolio, allowing for upside participation. These two funds are, I believe, the only ones that really use this strategy. They are very unique. It's one of the reasons why I have these two as my core positions. They are the biggest positions in my portfolio. These two, and then I built these two positions out first just because, one, the yield to me is very sustainable. They have been growing their NAV. They do have some tax efficiency, and it seems like they have downside protection. So, to me, yes, I put them in Gen 2 just because of the tax efficiency might not always be there. It just depends on how they, as you can see, they write 25 to 75% of the portfolio, and sometimes they uncap it or cap it, and you might end up getting more heavily taxed. That is my trade-off. For this purposes, I will put it in Gen 2. In my portfolio, in my portfolio, this is talking about my portfolio, I have it as like a Gen 1 core position just because I really love their strategy and how they operate. It's ever since their inception in October 2023, 2022, 2023, around there, October, November, I believe. I could be wrong, but they have at least 2 years of a history, and they've been doing well. So they recover when their stock price goes down during a dip or a flash crash of the April tariff. They've recovered quite well. I absolutely love how they execute their strategy. And then we got Amplified. These are active stocks with very, very active management, right? The active management chooses a concentrated portfolio of 20 to 40 stocks, right? DIVO uses blue chips, and QDIVO is growth, and tactically sells cover calls on individual stock position on a partial basis, right? Funds DIVO, QDIVO. I used to own DIVO, and then I completely sold out and rotated everything about maybe $200,000 into QDIVO. QDIVO, first thing they do is growth and then income. So if it's growth, you already have that NAV appreciation. So you have that NAV. There's no NAV erosion, right? They protect your NAV first, so that's one. And then tax efficiency, I would say it's still a Gen 2, maybe a Gen 1, just because they don't always write call. They use tactical calls, so they don't write everything on all of their portfolios. So you can end up either having very good returns or not. So I put in Gen 2 because you will never know until the end of the year. So there's that. And then hedge protection, downside protection. They have that because they hold quality stocks. They choose based on how the performance of these stocks, right? They choose excellent companies with moat. They're basically very, very good blue chip stocks. And then the yield, I think it's about 12%. I would say that's pretty high. So it kind of has all four, if not then 3.5. But I took off a point and put it down to Gen 2 for this video purposes. But in my portfolio, I would consider it a Gen 2, Gen 1. And then tax efficiency, right? We're just comparing Gen 3, 1256 versus Gen 2, mainly return of capital, right? Section 1256 is more tax advantage because when it comes to tax filing, right, this is the gold standard, right? All gains are treated as 60% long-term versus 40% short-term, regardless of holding period. It's a much more significant tax advantage versus just straight up return of capital. Uses ETF stock options, right? Gains are taxed as ordinary income, but funds are managed to distribute return of capital. This defers the tax liability until you sell. So if you don't sell, yes, then I would say it's good. But at some point, this doesn't fit for everybody. Not everybody's gonna have kids or pass down their assets. So then at some point you would have to sell. And then strategy deep dive on the collar, right? It just means protection. Collar ETF just means very protective ETFs, right? 1, they buy the stock. 2, buy a put option, and then 3, sell a call option. So when you buy a stock, you hold the underlying, whether it's SP 500 or the NASDAQ, to capture market exposure, and then boom, once you buy the stock, You buy a put option to create a floor and provide explicit downside protection, limiting potential losses. And then next step, the premium generated from selling the call is used to pay for the put, and this caps the portfolio upside. So you play both sides of the game, right? And then the defined outcome alternative is that you could hold T-bills, which is not an equity fund. The principal is held in T-bills for stability, right? T-bills is the most stable, right? And then you sell puts on it, and then you get a definite outcome, right? A result is a defined yield with a deep buffer against losses, but all equity upside is sacrificed. And then, of course, honorable mentions. I have to put QYLD, JEPI, and JEPQ. As much as I do like JEPI and JEPQ, for this video I have to disqualify it just because of QYLD has very disgusting NAV erosion, and JEPI and JEPQ does have very poor tax disadvantages, right? QYLD sells 100% at the money, and then JEPI and JEPQ has LENs, fails is taxed as ordinary income. I should have separated this too, but NAV growth, QYLD doesn't have NAV growth, so yeah, I should have made this a little bit clearer on this slides and separate it. But anyways, and then of course the yield map products, I really can't say I'm a big fan of it. There's no hate against UMax. It just doesn't work for me. It might work for you. And then their flaw is just everything. Right? They have poor tax, ordinary income. They do some return of capital, but you never know until the end of the year. So for me, poor tax, high NAV erosion by design, and no downside protection. Like it just fails on all front in my view. No hate. Just YieldMax doesn't work for me. It might work for you, whoever's watching. I'm not trashing YieldMax. Let me get that straight. YieldMax just doesn't fit my lifestyle needs at the moment. All right, practical limitation and risk, right? Recent buoyancy, right? Most Gen 3 funds are new. So we do have a limited history in a sustained bear market. So, of course, NEOS is all great right now. You're hearing this. Yeah, NEOS is fantastic, yada, yada. We have a limited history with them, with the exception of SPYI. But if they perform like SPYI did, then we might be good. Then we don't have to worry. The tax complexity, right? Section 1256, income must be reported on IRS Form 6781. I am not a tax professional. Fact check me on that. Return of capital is not taxed now, but lowers your cost basis, increasing tax later. So please, there are some workarounds, such as reinvesting to increase cost basis, and passing down your stocks to your kids or whoever for a step-up basis. You can Google those, and you can ask a tax professional. Strategic drift risk. Gen 2 funds like GPIX and DIVO are actively managed. So anything that's actively managed, like NEOS and all, has a risk, right? The percentage of portfolio being written against can change at any time. And of course, liquidity, right? Newer funds, RYLG, DYLG, NIHI have low assets under management, which could lead to wider bid-ask spread, which means you pay higher for the stock price when you want to buy. And then actionable portfolio, choose your trade-off. Again, and this is to Jerry B751, right? We can't choose an ETF that has all four. You're gonna have to give up something, right? You're either gonna have the 1256, right, which is the tax, right? You can get the yield plus NAV plus your tax protection, but your compromise is no protection. Or you can go with some of Gen 2 and you mix it up. Your goal is yield, NAV plus tax deferred. Compromise, you have no downside. I'm not gonna say no downside. I just put no downside protection just because it's not a hedged ETF that actually their entire strategy is downside protection. And then true hedge, you have protection plus tax, but you compromised on low or no yield. And then, of course, for defined outcome, you have yield plus protection, but no upside, right? Those are your treasuries and pretty much your bonds, right? Your high yield saving ETFs account on steroids. Subscribe, comment, like. I hope you guys liked the video. Jerry B751. This video is for you, and I hope you liked it. And this is for anybody else who had the questions. Leave a comment. If I find your comment very, very intriguing and interesting, I will, or you request it. If I can, I will go ahead and try to do my deep dive, and I'll try to give my opinion. And then I pretty much put as much, I find as much sources, and I try to just compare, and then I just fact check myself, put everything together, and this is what I come up with. Give my opinion and thoughts about it. And hope you guys enjoyed it. Stay tuned. See you guys on the next.